Picture this. You've finally done it. You've saved up $1,000. Maybe it took you 3 months. Maybe 6. Maybe you cut out the daily Starbucks run, picked up an extra shift, sold some stuff collecting dust in your closet. Whatever it took, you did it. And now you're sitting there, phone in hand, account open, feeling like you're about to cross some invisible line that separates regular people from people who invest. And then you freeze. Because suddenly there are 1,000 options in front of you. Someone on Reddit says, put it all in Tesla. Your coworker won't stop talking about crypto. Your uncle at Thanksgiving, you know the one, he says gold, always gold. And somewhere in the back of your mind you're thinking, what if I pick wrong? What if I lose it? What if this is the moment I either start building real wealth or blow the whole thing and end up exactly where I started? So you do what most people do. You pick something, anything, just to feel like you're doing something. Maybe it's a hot stock you saw trending. Maybe it's a coin someone on TikTok told you was the next big thing. Maybe you just wait. Wait for the perfect moment. Wait until you feel ready. Wait until the market looks less scary. And that, right there, but that waiting, that guessing, that picking the shiny thing, that is the $1,000 mistake. And 90% of first-time investors make it. Not because they're dumb, not because they're careless, but because nobody ever sat them down and told them the truth about how this actually works. So that's what we're doing today. No fluff. No, you've got this motivation nonsense. Just the actual math, the actual psychology, and the actual moves that separate the people who build wealth from the ones who stay broke while feeling like they're trying not to be. Let's get into it. Here's the thing. Most people get completely backwards when they make their first investment. They treat it like a lottery ticket. Like the goal is to pick the right thing, watch it explode, and cash out rich. And look, I get it. That's the story we see everywhere. That's the story that gets clicks. Some 24-year-old who turned $500 into 50 grand on some meme stock, and now he's got a YouTube channel about it. But here's what that story doesn't tell you. For every one of those guys, there are 10,000 people who did the exact same thing and lost everything. You just never heard about them. Because nobody makes a video called I put my savings into GameStop and now I'm eating ramen. The real mistake isn't picking the wrong stock. The real mistake is thinking that picking stocks at all is how regular people build wealth. Let me show you what I mean. A study by Dalbar, they've been tracking investor behavior for over 30 years, found that over a 30-year period, the average individual investor earned just 3.7% annually. Meanwhile, the S&P 500, which is basically just a basket of America's 500 biggest companies, returned about 10.6% per year over that same period. Think about that. The average person trying their hardest, picking their best stocks, reading their Reddit threads, and watching their YouTube videos, massively underperformed, just doing literally nothing except buying the whole market. That gap? That's not bad luck. That's a behavior problem. And the biggest behavior driving that gap is something psychologists call action bias. It's this deeply human instinct that doing something is always better than doing nothing. It's why goalkeepers in penalty shootouts dive left or right almost every time, even though statistically staying in the center gives them the best odds. It feels wrong to just stand there. It feels passive, lazy, like you're not trying. Investing hits the exact same wiring in your brain. When you have $1,000 on the line and the market drops 5%, every instinct in your body screams, do something, sell it, move it. At least feel like you're in control. And that instinct, that very normal, very human instinct, is costing average investors hundreds of thousands of dollars over their lifetimes. Not because they're weak, because they're human. And the market is designed to exploit exactly that. Now here's where it gets really interesting, and honestly, a little uncomfortable. Most first-time investors don't just make the mistake of picking wrong. They make 3 mistakes at once, and they happen so fast you barely notice. The first one is chasing performance. You look at what went up the most last year, and you assume it's going to keep going up. This is so common it has a name in finance: performance chasing. And research from Morningstar consistently shows that money tends to flow into funds right after they peak, meaning people buy high because it feels safe, and then panic and sell low when it drops. Textbook. Every time. The second mistake is ignoring fees. And I know that sounds boring, but stay with me here because this one will make you legitimately angry. Let's say you invest your $1,000 into an actively managed mutual fund, the kind a lot of banks and advisors will point you toward. And it charges a 1.5% annual management fee. Compare that to a simple index fund that charges 0.03%. That's the kind you'd find at Vanguard or Fidelity. On a $1,000 investment growing at 8% a year for 40 years, that fee difference costs you. And I want you to actually picture this number. Over $6,000. $6,000. Lost. Silently. Not from bad performance. Just from fees that most people don't even notice because they're buried in the fine print of a document nobody reads. The third mistake, and this one stings the most, is waiting for the perfect moment. There's this idea that floats around, especially when the market's been volatile, that you should wait until things calm down before you invest. Wait until after the election. Wait until interest rates drop. Wait until it feels safer. And look, I understand the logic. It sounds responsible. But here's the brutal truth. Time in the market beats timing the market. There's a famous hypothetical that JP Morgan runs in their annual investor guide. They looked at what happened to a $10,000 investment in the S&P 500 over 20 years if you missed just the 10 best days in the market. 10 days out of 7,300. Miss those 10 days and your return gets cut nearly in half. Miss the 20 best days and you're barely breaking even. And here's the kicker. The best days in the market almost always happen right after the worst ones. Right when it feels the most terrifying to be in. Right when every instinct you have is screaming to get out. So the people who wait for the right moment miss the moments that matter most. Not because they're unlucky. Okay, so by now you might be thinking, all right, I get it. Don't pick individual stocks. Don't chase performance. Don't wait. But then what? What am I actually supposed to do with my $1,000? And this is where most finance content kind of drops the ball. They'll say just invest in index funds and leave it there like that answers anything. Like you're supposed to just figure out the rest yourself. So let's actually walk through this. The what, the where, and the why in a way that actually makes sense. First, let's talk about what an index fund actually is, because it sounds more complicated than it is. Imagine you're going to a buffet. You could spend your whole meal trying to pick the single best dish on the menu, hoping you chose right, stressing about the ones you didn't try. Or you could just get a little bit of everything. If one dish is terrible, no big deal. You've got 30 other dishes carrying the plate. An index fund is basically the buffet approach to investing. Instead of betting on one company, you're buying tiny pieces of hundreds or thousands of companies at once. If one goes under, the rest carry on. And historically, the whole buffet, the whole market, goes up over time. The S&P 500 index fund is the most well-known version of this. It tracks the 500 largest companies in America. Apple, Microsoft, Amazon, all of them, proportionally. And over any 20-year window in history, it has never lost money. Not once. Even through the dot-com crash, the 2008 financial crisis, and the 2020 pandemic crash, if you held for 20 years, you came out ahead. Now, and here's the part that really flips people's thinking. You don't have to be rich to use this. Fidelity's Zero Index Fund requires literally no minimum investment. Vanguard's VOO, one of the most popular S&P 500 ETFs, you can buy with whatever your broker allows for fractional shares. So that $1,000, you can put the whole thing in today without picking a single stock, without timing anything, without needing to know what the Fed is doing, or what inflation looks like next quarter. But there's a layer on top of this that most people miss. And it's honestly the biggest unlock when it comes to building real wealth over time. It's called dollar cost averaging. And it sounds technical, but the concept is embarrassingly simple. Instead of investing your $1,000 all at once and panicking about whether you picked the right week, you break it up. $100 a month. Every month. On the same day. Automatically. You don't check the price. You don't wait for a dip. You just invest. Automatically. And here's what that does psychologically and mathematically. When the market is down, your $100 buys more shares. When it's up, it buys fewer. Over time, you naturally average out at a good price without ever having to predict anything. This is not a secret. This is literally what billionaires like Warren Buffett have told regular people to do for decades. In his 2013 letter to Berkshire Hathaway shareholders, Buffett wrote that when he dies, the instructions for the trust holding money for his wife are simple. Put 10% in short-term government bonds and 90% in a low-cost S&P 500 index fund. That's it. That's Warren Buffett's advice for his own family. Not stock picking, not timing. An index fund and consistency. Now let's talk about accounts, because where you invest matters almost as much as what you invest in. If you're investing your first $1,000 and you're doing it in a regular taxable brokerage account, you're leaving money on the table every single year. A Roth IRA is almost always the first move for someone starting out, especially if you're under 50 and not making more than roughly $161,000 a year as a single filer in 2024. Here's why. The money you put into a Roth IRA grows completely tax-free, not tax-deferred, tax-free. You pay taxes on it now, when you put it in, and then the government never touches it again. So if your $1,000 grows into $50,000 over 30 years, that gain, all of it, is yours. No capital gains tax. Nothing. The IRS doesn't get a single dollar of what you built. Vanguard, Fidelity, Charles Schwab, all of them offer Roth IRA. As with no account minimums and zero-fee index funds inside. You can set the whole thing up in about 20 minutes online. I'm not going to tell you that's exciting, but I am going to tell you that 20 minutes today could legitimately be worth tens of thousands of dollars when you're 60. Look, I want to be real with you for a second, because this is the part most finance videos skip. Knowing this stuff is not the hard part. The hard part is actually doing it. The hard part is opening the account when the market looks scary. The hard part is leaving it alone when every headline is screaming that the economy is collapsing. The hard part is watching your coworker brag about doubling their money on some options trade and not blowing up your whole strategy to chase the same feeling. Wealth, actual, lasting, life-changing wealth, is almost always boring. It's not a trade you made. It's not a stock you picked. It's a decision you made when you were young, or younger than you are right now, to stop treating investing like gambling and start treating it like a habit. Like brushing your teeth. Like something you just do, automatically, without needing it to be exciting. The people who retire with more money than they ever expected didn't do it because they were geniuses. They did it because they started. They did it because they kept going when it got uncomfortable. And they did it because they refused to let perfect be the enemy of good. Your $1,000 is not going to make you rich overnight. I know that's not what you want to hear. But that $1,000, invested consistently, growing quietly in the background while you live your life, that's the beginning of something real. That's compound interest doing what Einstein apparently called the eighth wonder of the world. Every year that money sits in the market, it's making you money while you sleep. It's working on weekends. It doesn't take vacations. And the longer you wait to start, the more of that free, automatic, effortless growth you're giving away. So here's what I want you to actually do after this video. Not think about, not bookmark, do. Open a Roth IRA. Fidelity or Vanguard, doesn't matter. Fund it with whatever you've got, $50, $100, your whole $1,000. Buy a total market or S&P 500 index fund. Set up an automatic monthly contribution, even if it's small. And then get on with your life. That's it. That's the whole thing. No stock picks, no market timing, no financial advisor taking a cut of your future. Just you, a low-cost index fund, and time. The $1,000 mistake isn't about losing money. It's about losing time. Every day you wait, every week you spend researching, every month you tell yourself you'll start when things settle down. That's a day of compounding you'll never get back. And unlike money, time is the one thing you genuinely cannot earn more of. So don't make the mistake. Start boring, stay boring, and 30 years from now, you'll be grateful you did.